Hi there, thanks for joining me. Today I wanted to discuss rate and points. What are they? What are some of the different options? And then how do I evaluate them? Um, how do they interact with each other, basically, at the end to become feasible and something that you feel confident discussing? The rate is the rate at which you are repaying the bank for the loan that you borrowed. There's generally two types, fixed rate and an adjustable rate. The fixed rate is what it sounds like. It's fixed. It never changes. If your loan term is 15 years or 30 years, it is that for the entire length of your loan. That's kind of nice. It provides you some security and safety just mentally, knowing that your principal and interest payment will never change. That's not to say that your taxes and insurance that we collect won't change. Those will change with time. But it's good to know that your principal interest, which is based on your rate, will never change. Second type of rate option, the adjustable rate mortgage, also known as an ARM. You'll probably hear that or see that around. Um, that is becoming more popular these days as we enter a rising rate environment. Um, how do we come up with an ARM rate? So I'm going to start with the first example, kind of what do we see first? We're going to see it kind of done like this, where it's going to be a 7-1 arm. That's the example I'm going to use today. And all that means is that the 7 here represents the fixed term. So we close at day 0. Your rate is fixed for the first 7 years. Never changes. The 1 here represents how often thereafter it adjusts. Um, so in this example, okay, on the 7th year, we have a rate adjustment. On the 8th year, we have a rate adjustment every 1 year after. There are some programs that might offer, let's say, a 7-7 arm. Again, that just means it's fixed for the first 7 years. And then if this second number is a 7, that means it adjusts every 7 years. The next logical question is, well, Shane, how does it adjust? Arm rates are made up of two um, two things, okay? It's going to be a base rate, which is based off of a market index. In the case of Home Street, it's based off LIBOR. That is the London Interbank Offer Rate. You can find this anywhere online. You just want to kind of Google 1 year LIBOR. We use the 1 because that's the adjustable fixed period here, the 1. And then you're going to add a margin, okay? Again, in one of our loan program cases, it could be, let's say, 2.25%. So we're at year 7. It's time for your rate to adjust. Well, at year 7, we're gonna go. This is not actually how we do it, but you're gonna go ahead and Google your 1 year LIBOR. Um, Recently, it was 3.1%, and then you're gonna add your margin. You're gonna know what your margin is before even locking a rate, before closing, and so you know that whatever the LIBOR is, the 1 year LIBOR plus 2.25 is going to be your rate for the next 1 year. So that's kind of how we get to that adjustment. Okay. Um, Up next is the points. Points are a cost that you are going to pay at closing in exchange for a lower rate. Okay, so you have the ability, I mean, you can pay nothing for points, but you're going to have a little higher interest rate. Or you can pay, 2 points, which is going to bring your interest rate down. When you hear points, points just mean that it's a percentage of your loan amount. So if we're saying half a point, then that's half a percentage of your loan amount. That's the cost that you're going to come in with at closing in exchange for a lowered rate. Um, Okay, so again, just if you see 0.75 points, just know that we're going to calculate that as 0.75% of your loan. And one of the ways that my sales manager, likes to illustrate how rate and points interact is the seesaw thing. And so I kind of squished it in here at the bottom, and I apologize, it's a little small. But say your rate now is 4.75%, that's what I'm offering you for a lock. Um, I'm going to say, hey, you can have 4.75%. The cost of that rate is a quarter point, 0.25 points. That's what that says. Okay? And you're thinking, well, Shane, 4.75 is cool, but I actually had in mind kind of a lower rate. Um, how do we get there? So you're thinking now we want to bring that rate down, maybe to 4%. That's what it says there. Okay, we can do that, but we're going to increase the points paid in order to buy that more attractive rate. And so in this case, I just kind of put like, all right, well, let's pay 2 points to get this 4% rate. And remember that the rate that you end up with is going to determine your monthly payment, your principal and interest payment. So one of the ways that I try to evaluate the feasibility of points is that, hey, you might be paying, in this case, 1.75 points more here, but you're now getting a 4% rate instead of 4.75% rate. That might be a difference in your monthly payment of, let's just say, $100. Okay. 4.75 rate gives you this payment. A 4% rate gives you a $100 less payment. So that's kind of nice. $100 less a month to be paying out of pocket. And after a certain amount of time, that $100 savings every month will recapture the cost that you pay for your points. It differs for almost every scenario, so that's something that you can work with me directly on um, to kind of hammer out. But it's something that I like to do and work through with clients just because it really makes uh, the buying of the points a little more tangible, and you're able to see it and say, okay, at this month I will have recouped the cost of the points, or um, hey, maybe it's not worth it right now for me to shell out so much money on points because I've got other plans for it. I want to move in. I want to buy a couch and um, some furniture, whatever it is. That's up to you. Anyway, that's my thing on rate and points. Thank you very much for your time. I appreciate it, and have a great day. Thank you.